joining us. Andrew and I are going to be talking to you about international and UK VAT and customs issues, and handing over to Andrew first of all.
Good morning, everybody. I'm going to first talk about the Trump tariffs. As a number of my colleagues have mentioned before, this is obviously a hot topic, constantly evolving, and even today there's various bits and pieces that are in the news to do with what's going on. But effectively, the state of play at the moment is we've got these various different tariffs depending on the type of products that are imported into the US. We've got the Liberation Day tariffs, which were announced back in April, affecting most countries who trade with the US. The recent development, which will have been in the news and everybody I'm sure is aware of, is the Federal Court of Appeals determination that the IEPA, the International Emergency Economic Powers Act rules, which the president has been using, is determined in this particular instance to be incorrect. So at the moment it's on hold, waiting for the Supreme Court of Appeal to have their judgment, which will be sometime in November. It's a state of flux at the moment because it has been approved for the current tariffs to be extended until the 14th of October, with a probable extension until the outcome of the Supreme Court decision. So it's status quo at the moment, but things could change. My understanding is there is a probability that the Supreme Court may take on the federal court's ruling. So it'll be interesting to see the outcome of that, because that has a significant impact on the current tariffs that are in place. In addition to that, I think it's important to note that if these tariffs were deemed illegal and were removed from the current policy, it's not an automatic duty reclaim process. It's making sure that businesses submit a post-summary correction within, I think it's 180 days of the date of import. Otherwise, those tariffs, even if they are deemed illegal, cannot be reclaimed under the current process. So I think if you're dealing with if you're importing into the US directly, or you've got customers who are affected by these tariffs, it's just being aware that you need to look at the potential opportunities here to get the duties back if the judgment does go against the president. The 10% tariff on Chinese goods has been extended until the 10th of November. So that's in addition to the 20% fentanyl. So one of the things that businesses need to understand is that there's the stack up of different tariffs. So if you're dealing with steel and aluminium, and also you've got those tariffs plus the 10%, etc., etc. So although it might seem small at the start, when you stack all these together, it suddenly becomes a significant tariff. With the pharmaceuticals, that was recently announced. For the UK, we've got a 10% tariff at the moment. With the EU, it's 15%. So we've obviously spoken to a number of businesses to do with pharmaceuticals, and there is a concern about this, and whether this will actually affect UK and EU pharmaceutical production. One other point I wanted to sort of raise was the de minimis waiver. So most countries, in fact, probably all countries, apply some form of de minimis waiver to help with low value goods. It reduces the administrative burden both on importers and the tax authorities. The US has removed the de minimis waiver it applied prior to the 30th of August, which was $800 for value of the consignments. So everything now that's imported into the US will be subject to some form of tariff. Royal Mail has introduced a system to be able to help UK businesses who are sending parcels, for example, B2C to US customers. So there might be a sort of an interim transitional period, but if you're involved in those types of movements, then it's worth looking at what options are available, and the impact of the de minimis waiver as well, because obviously if you're dealing with low value goods, 10% could significantly increase the sales price. But in addition to that, I think it's worth noting at this point is that this has sort of triggered discussions within the UK. They're also looking at that, removing the current £135 de minimis on imports, and the EU are also looking at this as well as part of their customs modernisation project to remove the €150 de minimis. So the world is changing. These low value consignments, which previously were outside the scope of customs duties, for example, will now fall under the remit, the same as bulk consignments. This slide just covers, the sort of Section 232 investigations that have been happening over the last few months. There was a recent announcement on the sort of a 50-day investigation on furniture. So businesses who are manufacturing furniture in the UK and EU may be impacted by the outcome of that investigation. The high-profile one is obviously steel and aluminium. The current tariffs are in place for UK at 25% with a special agreement. There was hope that would get reduced to a zero tariff, but that's not currently the situation. But other countries are subject to 50%. So UK steel producers and manufacturers of steel and aluminium products could benefit from that sort of temporary window at the moment. But the other ones, obviously copper, timber and lumber. Semiconductors is a big one because of the sort of AI going on at the moment with the chips and everything else. There has been a warning of 100% tariff unless businesses sort of invest in US production, and that's basically the reason for all of these different types of investigations and the liberation tariffs, is to try and increase manufacturing in the US and make the US less dependent on overseas resources. So the world is changing. It's affecting the whole scope of customs, and it'll be interesting to see how this develops over the next sort of 6 to 12 months. Another point that we wanted to talk about was to do with the delivered duty paid Incoterm. So for those who are not aware, the International Chamber of Commerce have a set of 11 different trade shipping terms that are sort of industry standards, and the delivered duty paid Incoterm sort of sits on the right hand side of the table, and effectively that makes the seller responsible for all of the responsibilities and obligations within the supply chain. And the key point is it includes the payment of customs duties. So what we're seeing with businesses who are agreeing duty paid Incoterms is there's potentially a lack of understanding, both within the business, but also within the customs agent sector. So it's important to make sure that when you're agreeing the DDP Incoterm, that you understand the potential VAT obligations, because it effectively puts you as the seller into that country. And what we're also seeing is that with agents misunderstanding the Incoterm, is that they're declaring the buyer as the importer, which brings them into the customs and VAT obligation requirements inadvertently, creating significant administrative and potential tax risk burden as well. So I think in terms of UK businesses who are involved in exporting, is knowing what your Incoterms are. Does the whole business understand those Incoterms? Because it might be that contracts are agreed, but those people that are actually arranging the shipping, are they fully understanding of what's required, what needs to go on the commercial invoice, etc. And also the overseas VAT obligations. It might be that the business doesn't have a choice because of the contracts that they have in place, but it's just making sure that you understand that actually you could be subject to VAT obligations in the country of import, and making sure that you register for VAT at the correct time to avoid any sort of tax issues. And what we've seen is if it's not been dealt with at the right time, that creates an issue because the wrong person's been declared as the importer. And certainly if you're shipping goods into the EU, the EU countries don't tend to be as flexible as HMRC are in terms of declaration amendments. Certainly with the Netherlands, we've seen businesses try to amend their declarations to change the importer name and EORI number, and that's very difficult because the Dutch authorities currently don't allow for just an EORI amendment. They'll only allow it if there's a duty or a VAT change as well. So that could create an issue for the business. But if you're importing goods under DDP, it's making sure that you're not declared as the importer. So check in to see if you've received any duty and VAT invoices, for example. Check in online to see if you've got a PVA or a C79 statement that you weren't aware of. They're the indicators to suggest that you've been declared incorrectly as the importer, and making sure that you take the retrospective action to make sure that an amendment is completed to avoid any sort of duty or potentially VAT risk on those consignments. And Alison will talk about the ownership part and the import VAT on that, because that sort of indirectly affects this whole process.
It absolutely does. Thanks, Andrew. As Andrew was saying, import VAT and who can claim it is vitally important, and not only with the examples that Andrew has just been given, where if you are a buyer from an overseas supplier and you may have been inadvertently named as the importer, at that stage you are not the owner of the goods, because it was imported by that supplier. They were the importer of the goods, so you're not entitled to recover that VAT. It's only the owner who can recover import VAT, and that can cause particular risks with DDP contracts. We've seen certainly agents entering the buyer as the importer when they're not, and then entering the import into postponed VAT accounting using that customer's VAT number, which is hidden away. You're not going to necessarily notice something on a postponed VAT accounting schedule and not be able to identify it as yours. So you may be recovering VAT that isn't yours. Same with, and we see this an awful lot with tolling manufacturers, contract manufacturing, and people who are carrying out repairs to goods, where the goods are being imported into the UK for a UK business to apply a process to it or repair it, and then ship it out again. HMRC guidance is very, very clear that it can only be claimed by the owner of the goods. We're finding that this has been tested at the courts. So the Pyramid Healthcare UK case related to a tolling manufacturer for pharmaceuticals, and that was found that they were not entitled to recover that VAT because all that they were doing was packaging and processing the goods and then shipping them out again. This is now being really focused on by HMRC, and VAT assessments are being raised, and we've seen this happening regularly. So our advice and sort of suggestions to you as importers, or particularly if you're in contract manufacturing or repairs, you need to be really aware that this is a spotlight is on this from HMRC, and that you need to be sure that you are the owner of the goods if you are looking to recover import VAT. If you've recovered it incorrectly, then please, you need to correct it. And you also, we've found particularly with imports into the UK where you're not the importer, but the goods are being delivered to you. The agents are entering the details of you into their as being the importer of the goods. So really do keep a look out on those postponed VAT accounting schedules that you have that you would use to recover your VAT, which Andrew will talk about in a second, but they're really, they drop off the system after 6 months. So I would really recommend that if you're using postponed VAT accounting, or if you feel that somebody's declared it to you under postponed VAT accounting, to go into your government gateway account and get into that and make sure that you can access those and keep a regular eye on them. So Andrew, back to you on changes to PVA.
Thanks, Alison. Yeah, so one of the recent developments is a tightening up of the understanding of postponed VAT accounting. So this was introduced post Brexit, because prior to Brexit, any import into the UK was subject to payment of VAT at time of import. So obviously you pay the import VAT, you then reclaim it on your VAT return once the C79 has been issued for that declaration. But the introduction of postponed import VAT accounting allowed for businesses to effectively waive the payment of import VAT, provided they put the right details in, and then it generated a postponed VAT statement against that importer reference to be able to put it through the VAT return. But it's just making sure that you have the required processes in place. And the main point that HMRC are focusing on at the moment is whether the business has a written instruction. And that was updated on the 9th of June, which effectively sort of clarifies that you can only use postponed import VAT accounting if you've got a written instruction with your customs agent. So HMRC, we've seen HMRC looking at this in particular as part of a customs audit, where they're asking the question, you're using postponed VAT accounting, do you have a written instruction? And it might be that when the business set up an agreement with the agent via a direct representation form, that it was just a tick box. That would be satisfactory evidence. It tends to be quite common, but there is always that risk that you've not retained that document. The agent has misplaced it, or it's archived so they can't find it. And if it's not presented to HMRC, they will disallow the use of postponed import VAT accounting. And what that results in is a customs assessment. So the customs officer will raise an assessment for that import VAT because the PVA has been disallowed. They can go back up to 3 years, so that could create a significant cash flow impact. Provided you're the owner of the goods, you can reclaim that VAT back once you get the C79, you've paid the import VAT, but it does create a cash flow issue. So I think our advice really is to make sure that you have the evidence available. And if you haven't got that, you can either ask the agent, can you send me a copy to make sure you hold that on file, or if there is nothing, as a minimum, submit a written instruction to those agents to make sure that there is something on file, at least going forward, to minimise the potential impact that this issue could cause. So it is something that HMRC are focusing on, and it's a sort of it's a simple win for them. Moving on, we just want to talk about a couple of sort of supply chains that we're sort of seeing businesses look at. So post-Brexit trading, when Brexit hit, businesses had existing supply chains, and they had to try and manage the continued flow of goods from 1st of January 21, and businesses looked at it in different ways. Sometimes they were dependent on the sort of Incoterms that they'd agreed, and perhaps the timescales in which they had to deliver those goods meant that they had to do it a certain way. So in this particular scenario, we've got a UK company holding stock in the EU. So goods could be coming in from the Far East, being imported into the UK for onward distribution into the EU, or it could be directly into the EU. Pre-Brexit, it would only have been intra-community sales, so there wouldn't have been an issue. If it was coming from the UK into the EU, there wouldn't have been a problem. Post-Brexit, exports from the UK and importing into EU requires a customs declaration, and there is that risk of double duty. So, for example, if you were importing plastic from the Far East, it might be 6% into the UK and potentially 6.5% if it's going into the EU onwards. So one of the things that we've seen businesses look at is setting up an EU hub, which might mean direct imports into the UK to manage the UK and Ireland, and direct imports into the EU hub to manage the rest of Europe. Doesn't have to be their own warehouse, it can be a 3PL, but it's looking at the location of where to hold that stock. And generally we tend to recommend, or it's common practice, to put that into one country, because it simplifies the whole customs and VAT compliance obligations by holding it in one country. A country such as, in this example, the Netherlands, means that sea freight routes are very good into Rotterdam. Stock can be held in the Netherlands, customs cleared in the Netherlands. It's then just subject to EU VAT requirements, and therefore it sort of manages the process as per sort of pre-Brexit. So that's the sort of simple version, one of the things that we have seen businesses look at is setting up an EU entity. It's not something that you have to do. Certainly from a customs and VAT perspective, you don't need a legal entity in Europe to be able to import the goods. You just need an EORI number and, where necessary, a VAT registration. But in some cases, we've seen businesses have to set up something in the EU for product compliance purposes, and that might help with managing the customs process as well. So it's something to sort of look at if you're importing goods primarily into the UK at the moment, but you have a large EU sales market. What are the opportunities to be able to hold stock in the EU to sort of manage that process, or do I have to ship directly into those countries? With this next scenario, we've talked about delivered duty paid, but this sort of just highlights the sort of potential risks of selling DDP. So if you're selling from Great Britain under a DDP, effectively the goods are going directly into those member states. So if you're selling to customers under DDP, you could theoretically have to register for VAT and import those goods into 27 different member states. So to manage that process, one of the sort of opportunities to import them in and customs clear them into one member state. That allows the goods to be customs cleared, customs duties paid, and then the goods can be moved on to the end customer without having to VAT register in all those different member states. So it sort of then follows on the sort of post-Brexit rules. So again, it's making sure that you look at, well, which location do we need to import into, depending on the type of goods or where they're coming from. There are different locations that might be beneficial. So if everything's coming in air freight, it doesn't necessarily mean that you need to be near a seaport, but in most cases, Rotterdam is a key area, because most sort of Far East traffic tends to dock at Rotterdam to be able to supply into Europe. And also the Netherlands tends to have quite good links, and can also use the limited fiscal representative process, which Alison will talk about.
Thanks, Andrew. So yeah, limited fiscal rep, it's really very handy. Say you have a really simple supply chain where you're going to ship it into the EU. Say it's France, or say it's the Netherlands, but then those goods are then going on to your customer in another EU member state. They're registered for VAT. So rather than your business getting registered for that, you could appoint a limited fiscal rep. Both the Netherlands and France have good VAT deferral schemes, so that limited fiscal rep will import it on your behalf. They will then move the goods on to your customer in another EU member state. They will deal with that intra-EU VAT accounting on their VAT return for you. You don't need to register for VAT. It's a nice, simple way of dealing with it. We see it happen an awful lot. Obviously, probably only relates to those nice, simple supply chains going in by sea into one of those northern countries, but works very, very well. Of course, all the supply chains we were just talking about, see goods being imported from outside the EU into the EU. For VAT purposes, where you're buying and selling, the goods are already in the EU. So say you're buying from France and supplying onto your customer in Germany, then you will need to consider VAT registration for intra-EU transactions where the goods are already there in Europe. I think, Andrew, is it back to you now?
Yeah, so
Northern Ireland.
Yeah, just a quick update on what's happening with Northern Ireland and the Windsor framework. So some things have sort of changed over the last few months in relation to the sort of process and the introduction of the Internal Market Movement Information, or IMI, which was introduced on the 1st of May. And basically that allows for the simplification of data required to get the goods into Northern Ireland. So previously you would have to submit a supplementary declaration after the goods had arrived in Northern Ireland, and that was effectively a full customs declaration, detailing things like commodity codes, values, and then that would account for any customs duty, or be the point of which you confirm whether the goods are at risk of leaving the Northern Ireland territory or not. With the IMI, it enables a reduced or simplified data set. That's not to say it's just a couple of boxes, but a lot of the process is done front end now. So there's a requirement to do a sort of a safety and security declaration, which provides a lot of information. So in most cases now, the customs agent will probably be doing that on your behalf. So you provide the details on the commercial invoice, pretty much as you would do for an export into France, for example. They would use that information to populate the safety and security declaration and submit the IMI as well, which only requires a simplified commodity code, for example, as a sort of a 6-digit commodity code, as opposed to the 10-digit, which was required under the old system. Linking into that, there's the introduction of the trader goods profile. So every company that's registered through TSS will have an allocated trader goods profile, and what that includes is details on the commodity, the goods description, and all those sorts of things. And that would then enable the person who's inputting the IMI to basically use that information rather than have to keep typing it all in. So if you're doing regular shipments of the same types of products, it might be that the trader goods profile is useful to simplify everything, because it's a simple process of uploading that information with all the document references, which saves time for everybody and means that everything is done front end. So when the goods arrive in Northern Ireland, there's no requirement to do anything else apart from make sure that you retain the evidence of export, so the ferry tickets and all the commercial transport documentation that goes with that movement. So effectively, it's what we call the entry in declarants records, the EIDR, and via the UKIMS process, which businesses must have to be able to operate the simplified process. It enables this to work. One of the things that we have sort of noticed is with the trader goods profile, it's not necessarily an efficient process. So we have businesses that have significant number of parts that they ship across to Northern Ireland, and just managing the upload of all that information doesn't appear to be particularly efficient. It requires significant data to be manually inputted onto the system, and also regular monitoring. So if you're constantly changing those products, you constantly have to monitor it. So I think for businesses that are doing the sort of IMI process, is making sure that the business has a process to enable them to manage that efficiently. And hopefully HMRC will be able to provide some sort of upload system in the future to be able to make that an easier process. But effectively,
sorry Andrew, I think we better hurry along.
Okay.
We're on 10:30. Guys, is it okay if I just go over 2 minutes?
Yeah, absolutely. A couple of minutes is fine.
That's lovely. Sorry to interrupt you there, Andrew. I think we need to quickly go through onto EU updates for the VAT in the Digital Age refresher, because if you have a subsidiary in Europe, in Belgium, France, Germany in particular, then you need to be thinking about how you're going to deal with e-invoicing in the next couple of years. With Belgium, you've got B2B e-invoicing for established businesses coming in 2026. So if you have a subsidiary, you need to be on top of that. Likewise with France, but they are saying that you just need to be able to accept e-invoices. For Germany for 2027, then also you need to be able to issue e-invoices. The standard that everybody needs to be looking to work towards is listed there, EN 16931, and you have to, by 2030, be able to issue those within 10 days of the transaction taking place. So for now, if you're established in any of those countries that I've just mentioned, Belgium, France and Germany, we really need to be looking to address e-invoicing. If you're non-established, we're not immediately affected, but do check your status. By 2035, the whole of Europe is expected to have real-time reporting, digital real-time reporting using e-invoicing to the authorities. Ireland and the Netherlands have not got any mandate yet. So I think that's worth bearing in mind, that these countries are ahead, but other countries are waiting to see what happens. 2030, travel and accommodation platforms such as Airbnb, there'll be a deemed supplier, so you will be paying VAT our Airbnbs from them. From January 28, one-stop shop, which we ourselves use, that is to enable you to do certain B2C sales within Europe on one VAT return, one VAT registration. From 2028, it also extends to if you have to import those goods into the country, into Europe, then that will allow that movement to be covered as well. So you don't need to register for the import of those goods. It can all be done on that one-stop shop. Just as a hint, if you're having to do that, I find that Ireland is really, really easy to get a one-stop shop registration, and the return is quite easy as well. Netherlands is also relatively easy. Next slide, please, Andrew. Just to say, in the UK, we're expecting a proposal for our own e-invoicing in November, and expect a similar 2030 deadline for us to also have to be implementing it. Go on further, please. A couple of current UK developments for VAT groups. If you're in a VAT group, you'll appreciate how important it is to manage those members going in and out of the VAT group. Prudential case highlighted that somebody had left the VAT group but wanted a contingent payment later down the line. Prudential had to pay it, even though it related to work that was carried out earlier. They couldn't recover it because the tax point happened after that member left the VAT group. So just a reminder to really keep on top of what's happening with your members. If you have a defined benefit pension scheme, HMRC is now allowing VAT to be recovered on the investment part as well. So previously there was a 30% admin, 7% investment. The employer could claim back the 30% admin. Now you can claim back 70% as well. If you had one of these schemes and you haven't done that, an opportunity to go back 4 years and get a refund from HMRC. Next slide, please. Just a little bit on error corrections. There's been a little bit of a change of emphasis on voluntary disclosures. Now, you can still correct your errors if they're under 10 grand or under 50,000 if you have high turnover on your VAT return. But where the change is there's no longer the form that you used to be able to use. You have to go via your government gateway account, do it that way. Your agent can do it for you as well. We've done a few, they're quite straightforward, so that's good. But it's now the emphasis in the guidance is now saying if you've made a careless error, you need to tell them. So the problem is, well, what's careless? Because an error by default is going to be careless, isn't it? So HMRC defined careless as a failure to take reasonable care. So what can we expect from this? I think HMRC is going to really look at corrections. So if you have a VAT visit, they're going to be asking you what errors have you corrected on your return. Be ready to be able to show and explain what you've done and why you took reasonable care. Maybe a very prudent route is to correct everything by going to HMRC. My own personal view on that is that the system would collapse and you'd be waiting years. Maybe the best thing to do is to tighten up your processes so that staff are trained. You take advice if it's a really complex VAT position, so that you've taken reasonable care there by going to get advice, and that you put processes in place to show HMRC that you've taken reasonable care. I'd like to wrap up, I think, with 2 final slides. We've all been talking about the budget. Just a couple of stats. 171 billion of the VAT receipts. We talk about, well, we can't change those. Obviously, looking at the other rates around Europe, other countries are starting to edge their rates up, with over 20 being shown here in a number of cases of our close neighbours. That would obviously raise an enormous amount for the Treasury, but Rachel Reeves has said that she won't be doing that. Environmental taxes and APD, you know, even if those were doubled, it's still not going to get us very far down the line, is it, for the black hole? So I thought, well, maybe Rachel Reeves could look back into history, and when we look back and see what other taxes were used, Then we've got hat tax back in the 1700s, and also for the ladies, a perfume and powder tax. So maybe Rachel would like to consider history for other taxes to consider. Thank you for listening.
Lots of insights there on the VAT side, and tariffs is absolutely one of the most important topics impacting many businesses. So.